You're watching The Open on BNN Bloomberg. I'm John Oakman. Nice to have you with us on this Thursday. Quieter day in North America with the U.S. Thanksgiving holiday. Gives us an opportunity to talk about certainly the story for the TSX, but also where we are in this market cycle. And to do so, we're joined now by Martin Roberge. She's a North American portfolio strategist at Canaccord Genuity. Martin, it's always great to have you with us. And as I've said a couple of times already this hour, the TSX is putting together a pretty strong month of performance if you compare it to most of 2023. Certainly the U.S. market has been having a pretty strong run. What's been your assessment of what's been happening in the stock market recently?
Yeah, we've shifted into another stage of the business cycle where we remain in late cycle dynamics, but we are in the sweet spot where usually when you see a gentle decline in bond yields related to weaker growth or weaker inflation data, the Fed usually backs off, and the initial maybe like 75 beeps decline in yields will benefit stocks. The challenge eventually becomes if there's another 75 beeps and bond yields decline later in 2024, will that decline reflect the possibility of a recession or a soft landing?
Yeah, that is the tricky spot. On that front, what are your recessionary fear bells looking like right now?
Yeah, it's kind of yellow right now.
Okay.
So we're writing our annual outlook right now, and we've been crunching so many charts this week and over the past couple of weeks, and the outcome is kind of very weird. We get into this situation where we're likely to experiment what we call a white collar recession. The good news is that when you look back historically, there are not that many episodes like that, but usually you would see a longer or prolonged business downturn, but a shallow downturn. It reminds me about Canada, like in 1991, 92, 93. We were kind of stuck in the glue because of the GST and the tight monetary policy with John Crow, I believe. And so we were kind of stuck in the glue, but the recession was so kind of shallow that it was not a disaster for stocks. And actually we had a good stretch for the TSX back then.
I get to cheat because I've got Bloomberg data in front of me. So 1991, the TSX up about 8%. 1992, we're down 5%, and then 1993, we're up 29%.
Yeah.
Okay, so obviously, to your point, there's a lot of economic situations that could unfold that we'll have to watch and try to match with what history tells us. I did set up this segment before you joined us saying that you were going to give us a little bit of a history lesson on what happens when we are at the end of a rate hike cycle. And I guess, to your point, it depends on where the economy lands. But would you say we are already in, because the market has been rallying, are we already into that phase of equity rally that typically comes at the end of a rate hike cycle, even if the central banks haven't quite said we're done?
No, actually, yes. And actually, if you look at I can maybe refer to the outcome of a report. Stocks usually perform well. Like the average 1 year out from the last hike is about 15% for stocks, 10 like at U.S. equities, 10 for Canada, and then the return for bonds is almost as high as stocks. We're talking about 14%. The difference, twofold. First, the range of outcome for stocks are very wide. Like, John, remember 2000, the last hike was not really positive. However, the last hike in 2018 was very positive. So the range of outcome, or the possibility to see a positive return, is much higher for bonds than it is for stocks. That's number one. Number two, when you look at the outperformers, usually defensive sectors outperform the market. So you can see that the risk appetite is not necessarily at 100% if investors are favoring defensive sectors. So this is kind of this environment where maybe Canada could probably do a little bit better this year because our bond proxies have been performing very badly. And on top of that, the commodity cycles, will start to look at 2025 when we should be out of the manufacturing recession. So the setup is pretty good for the TSX for 2024.
Okay, so that's a good guide, I suppose, on where some of the sector money could go. And as you were saying that, just to repeat for our audience, it sounded like you said that typically from the end of the last rate hike, as we move into that period, that change in policy period, that a year later you see the TSX up at least 10%, the S&P 500 up around 15%. I'm just looking at those respective indices off their October lows. I know this is not an exact science, but the TSX has rallied in the neighborhood of 7.5% off its recent lows. The S&P has rallied about 10%. So would it be fair to say that based on what you're seeing with history, you wouldn't be surprised to see over, moving into next year, a possible additional bit of upside for the equity market?
Yeah, and not like it's. I doubt that we will repeat 15 for the S&P. Two reasons. First, if you look historically at last Fed hikes, the average P/E ratio, forward P/E ratio, is 15. We're now, as you know, John, around like 19 something. And then also, very importantly, at the last Fed hike, the average PMI is 53, and the average LEI, leading economic indicator, is positive, is always positive. Right now, the PMI is at like 46, 47 in the US, and also the annual change in the leading indicator that we got this week is down 7.5%, I believe. So odds of slower growth are higher at this last hike than at previous last hikes. Okay.
Yeah.
This is why we should temper the return expectations from our analysis.
Well, like